Good evening. Welcome to our Mississippi State Alumni Association Homebuyer Workshop. My name is Jason Maida. I'm going to be your host and presenter for this evening. Really excited to get a chance to connect with everyone this evening. In fact, depending on what time zone you're in, you might be as a good afternoon, I should say. So thank you so much for taking time out of your busy schedules to meet with us. This is a very interactive class that we provide to the Alumni Association 4 times a year. This is our first installment of our class this year in 2025. We'll have other future classes available to you to attend. So, if you've enjoyed tonight's content, which we hope you do, you'll be able to share that with some of your friends, family, or coworkers that might want to attend a very similar class like this. These classes are very interactive. So as we go through tonight's session, really encourage you to ask questions. I'll be kind of monitoring the chat and Q&A within Zoom. And if we have some questions that pop up, we'll bring them back to the group. But ultimately, this class is designed to provide you tools and resources on your path to home ownership. So wherever you're at in the different parts of the country, we want to be a partner for you in that journey. So ultimately, it starts with classwork like this, learning a little bit about home buying, what tools are available to you, what's the process look like, have you in a position where you kind of understand what this can be for you and your future financial goals, and then help you along that journey to getting hopefully the keys to your home at some point in time. Well, again, my name is Jason. I'll be your presenter this evening. I work for an organization called American Pacific Mortgage. We're a nationwide lender. We service all of our local communities in home ownership. And again, we start with classes just like this. This is our second year of partnership with Mississippi State Alumni Association. In fact, I was on campus just last summer. I got a chance to get a quick tour of campus. Really impressed with everything there, and it's nice because it allows me to get a better connection to what's going on campus, and of course the overall culture within Mississippi State. And so it's really exciting to be able to partner with you in classwork like this. So we're going to get started in our topics. I know some of this you're kind of joining the class as we kind of go past the top of the hour. Here's our talking points for this evening. We're going to spend some time looking at the housing market itself, what's going on with interest rates, what's going on with inventory levels of housing market. So we're going to talk a little bit about that, which is a kind of a fluid situation in today's market. And then we're going to kind of spend some time looking at budgeting for home ownership. What does it look like if I compare renting today versus deciding to take the path towards home ownership? We're also going to look at some things around credit, helping me kind of maybe understand a little bit more about how I can optimize my credit so I can reduce my borrowing costs. So I'll give you some tips and tricks around that. We're going to look at different programs that are available to you as first-time buyers and give you some kind of terminology that you may have heard in the past as it relates to financing options. And then we'll talk a little bit about saving for home ownership. What does it look like to basically have assets that I can use for home ownership? But if I'm not quite there from a savings perspective, what are some different ideas you might have that can help you create savings for home ownership? I also want to talk a little bit about first-time home buyer programs that are available all across the country. So depending on what market you decide you want to buy in, we'll kind of spend some time looking at various assistance programs. We'll also talk about the home buying process. So after you leave class tonight, if you're interested in pursuing more about setting the home buying plan for yourself, we're going to talk to you a little bit about what are the milestones that you're going to go through in that kind of that process to obtaining home ownership. And finally, talk a little bit about what a consultation looks like when we help you design your own customized home buying plan. All right, so that's our plan for tonight. Again, we appreciate you taking time out of your busy schedules to get a chance to attend this class. Tonight's class is being recorded. We're also going to share back all the presentation material tomorrow morning. So we'll have this up on our YouTube channel tomorrow, also sharing back all the presentation material with you as well. So feel free to share that with friends, family, coworkers that you think might enjoy this content. And again, we're going to have future classes available this year and beyond. All right, well, let's talk a little bit about buying. Does it make sense for me? This is probably going to be one of the biggest financial decisions you decide to make. And so, obviously you're taking time out of your busy schedules to attend a class. So you obviously understand the importance of something like this. And so when we consider home ownership, there's a few really key benefits that come along with home ownership. I have the opportunity to create a little bit more stability in my housing costs because I don't have to worry about my rent being raised maybe every time I renew my lease, right? And, while we're at higher than, historical levels in terms of interest rates, many of our clients buying all across the country at some point will be looking to refinance their existing loan that they buy using today's financing into maybe a lower rate option a couple of years from now. So even though we're buying at today's levels where they're a little bit more elevated, there will become a time when clients can potentially refinance, which essentially is saying, I'm going to take my existing balance and take it from, let's say, a 6.5% rate down to maybe a 4.5 or 5.5% rate to create monthly savings for myself. Okay, so that improves home ownership when I can lower my monthly costs. And then this is an asset. Again, it's probably going to be the biggest financial decision you make, but it's also probably the biggest asset you have. And generally, real estate will grow over time. So as my home goes up in value, as I pay down my balance, as that number continues to margin or the margins continue to spread, that means I have more equity in my home. So my home goes up in value, I pay down my balance, I create equity for myself. So really, that's probably one of the biggest sources of most assets for most families across the country. And it really has the opportunity to create generational wealth. And believe it or not, there's still some really great tax benefits that come along with owning a home, the potential deductibility of mortgage interest on an annual basis, and some of the energy efficient upgrades that you make to your home can also be potentially tax deductible. So when we think about home ownership, I always encourage our clients, let's plug a lot of those great benefits into the calculation when it comes to deciding of owning a home versus continuing down that path of renting that I'm currently doing. Now, one of the ways that we can kind of better frame this up for ourselves as future buyers is to do kind of a rent versus buying calculator. In our classes, we always like to kind of walk our clients or our attendees through what this rent versus buying calculator is. And we're going to go and drop into our browser here to kind of just look at what this calculator can kind of frame up for us. And as I mentioned earlier, when we launched into class, we're going to send out all this presentation material to you tomorrow morning. So this will also include the link through the exercise that we're going to walk through right now. So this is a rent versus buying calculator that's brought to us by Freddie Mac. You're going to learn a little bit more about Freddie Mac and Fannie Mae later on in tonight's class. But I just want to walk us through just a really quick budgeting exercise so you can see what that might look like for you. And so in our scenario here on screen, you can see we have someone that's paying $1,500 a month roughly in rent. In their income or their monthly expense for rent, they have $15 in renter's insurance coverage. And then we're going to make the assumption that that particular scenario or client scenario is going to have rent increase 3% on an annualized basis, okay? Now that would be on my column of renting. And then from a purchase perspective, you can see the window I just opened up. Let's assume that we're going to purchase, let's say, a $300,000 home. We have a 3% down payment. The taxes or property taxes for that particular home are estimated around $3,500. We have homeowners insurance costs, and then finally the maintenance cost of the upkeep of my home. So we want to factor that into the calculation. So that's what it would look like from a home purchase perspective. But we also want to take in consideration, what does our financing look like? Because that will obviously drive our monthly payment, principal and interest of the loan. So we assume a 30-year fixed mortgage. We have an average interest rate around 6.5%. And then we have origination charges. That's what a lender will charge you for your financing costs. Now, one of your added benefits beyond the home buying class that we're teaching you today in the Alumni Association is we actually discount our cost in financing. So whether you decide to refinance or you decide to purchase a home, we discount our services by $750. So another added benefit for you through the Mississippi State Alumni Association. All right. Now, there's also discount points at times if a consumer elects that. And what a discount point is where someone decides to pay additional funds out of pocket in order to bring down my interest rate. Now, in today's market, we don't generally recommend clients doing that because it usually takes about 3 to 4 years for clients to break even on those type of investments. We'll talk more about that in just a little bit in tonight's class. And then there's other settlement services. Those are going to be things like attorney's fees to orchestrate the final signing docs of my loan or my home purchase, maybe title and escrow fees, county transfer taxes or charges depending on where you're at in the country with your home purchase. So we want to bake that into our calculation as well. When we think about home ownership and what we have to save up for, I would say think about saving up for our down payment, which could be as minimum as 3% of the purchase price. We also have closing costs and prepaid items that are part of our home buying. And so Closing costs on prepaid items generally can be about 2 to 3% of our overall purchase price. I'll spend some time kind of talking a little bit more about that, but I would want us to kind of start thinking about a little bit about that. So we save up for down payment as well as closing costs and prepaid items for our home. Now, some other assumptions we're going to make is the appreciation rate of my home. That'll obviously vary depending on where we're at in the country. We have 4% as the appreciation rate. Expected years in the home, 7 years. We have our selling costs. So we're going to kind of show you a side-by-side comparison. So if I rent for 7 years, what does it look like if I decide to buy for the next 7 years? And ultimately, when we decide to sell at the end of 7 years, there's going to be some costs associated with that. We have state and federal tax rates, and then we have savings rates that we'll put into the calculation. So if we kind of go off to the right of this calculator, we look at now a payment comparison. So I know I'm paying rent of about $1,500 a month. If I compare that to owning, my budget's going to go up by about $1,000. Now I'm going about $2,500 a month in home buying costs. But where I think the opportunity lies for us as future home buyers is that if I compare renting versus owning over the next 7 years, my ownership opportunity is about $43,000 in upside by owning a home versus deciding to rent. And how I achieve that upside is by the appreciation of my home over time, which we talked a little bit about earlier in our benefits to buying, but also around tax benefits or energy efficient improvements that I make to my house. So, when we consider home ownership, while we might be increasing our monthly outgo, those benefits truly exist in terms of appreciation and tax benefits and more added control in our overall budget for housing. So I would encourage you, sometime tomorrow after class, maybe take some time to do your own budgeting exercise. I think it'll be a really kind of enlightening experience so you can kind of really see, where you're at as it relates to your comparison of renting today and continuing down that path versus what it looks like as a home owner. Now, one of the considerations we have to make in home ownership is what's the housing market doing right now? Now, we're going to give you a snapshot of what the Mississippi housing market looks like. I know our class was shared with the entire country, so wherever you're at in the country, these trends might look similar, maybe slightly different. Certainly, the median sales price will change depending on where we're at in the country, but I want to kind of give you a little bit of a snapshot of looking at this chart over the last 3 years, if you will, in the housing market, relatively stable in the Mississippi market. Now we are going into the spring buying season. We're already in spring. Traditionally, spring and summer are the busier times of home buying all across the country. As the weather gets nicer, buyers and sellers become a little bit more engaged in the housing market. And what will drive a lot of buyer behaviors is what's available on the market, but what do interest rates look like? And so we're going to talk a little bit about interest rates in just a minute, but I think it's important to kind of see what's going on here in terms of the trend of the market. You see a little bit of a dip at the beginning of the year. Probably that some of that was just the seasonality in the market. So you can see kind of now we're starting to go back up a little bit as it looks in the Mississippi housing market. But, as we kind of look forward into spring and summer buying months, I think we still have the challenge of inventory in the market, which ultimately means having enough supply to support buyer demands. And, every housing market across the country is going to have varying appreciation rates. Some markets will appreciate faster than others, but they also will be possibly higher cost of living markets. So we have to take that into consideration as we look at our plan for home ownership. And another thing we're going to consider is what are interest rates doing? And so interest rates are starting to see improvement in 2025. In fact, today we hit our best levels of interest rates in 2025. And interest rates have been a bit choppy over the last 6 to 12 months. And we're going to kind of look at interest rates here for the last 12 months, as well as what does the snapshot look like over the last 20 years. There's a lot of economic pressure out there, a lot of uncertainty what's going on economically. There's talks of obviously the tariffs going into place today that you may or may not have heard of. That obviously has some strain on markets. So markets are trying to figure out what's that going to do to the U.S. economy. We saw the 10-year Treasury note come down to 4.13 today after starting off closer to 4.22. So we've seen a little bit of softening in the interest rate markets. I think as future home buyers, it's important to understand that when we have uncertainty or negative economic news, generally that's going to help improve interest rates. And so that's why we had a little bit of improvement in interest rates. I think we still have a little bit of a bumpy road to go this year in interest rates, but ultimately we will start to trend down in interest rates. Why we're here from a elevated interest rate level is really because the Federal Reserve has ratcheted up the federal funds rate to help combat inflation. So, we can feel the cost of housing. We feel it in the cost of when we go to the grocery store. Things are just more expensive. Now we're starting to see inflation start to improve a little bit, but the inflation goal for the Federal Reserve is 2%. We're still at elevated levels. I think the last reading was somewhere around 2.6%. So we still have work to do. But ultimately, as we move through 2025, we'll probably see the Federal Reserve cut rates, probably somewhere around 2 cuts this year in 2025. That will help improve borrowing costs for credit cards, auto financing, lines of credit, things like that. But it also helps create a ripple effect into the lowering of mortgage interest rates. Now, over the last 20 years from interest rates, we're not too far off the levels we saw 20 years ago. In fact, you can look back in the early 2000s, interest rates look very similar to what we see today. You can see the blue line represents the 30-year fixed mortgage. Our lowest levels that we've seen historically were during the pandemic, where we saw rates hit as low as 2.5%. The question I get from a lot of future first-time home buyers is, when will we return to those levels of interest rates? Well, let's hope that we don't, because ultimately that probably means something catastrophic is happening globally in the economy or in the world. And so ultimately, historical levels look like around 4.5% to 5%, maybe slightly higher. That's generally where we see, and that 20-year look back kind of represents a lot of that. Buyer demand will be fueled by interest rates for the most part. And as we see interest rates start to trend down, well, we will see buyer activity pick up. And I think the question mark in most parts of the country is, do we have enough supply to ultimately support the buyer demand, whether that's new construction or resale homes? Now, what goes into interest rates, I think, is really important, because interest rates aren't a one-size-fits-all. There's varying factors that go into interest rates, things like credit score, what my product eligibility looks like, what loan program I'm going to select, how much do I decide to finance, what does my down payment look like, do I decide to put a little bit more money out of pocket and bring down my interest rate? That could help influence whatever my interest rate lands on. And loan term can also change interest rates. So generally, the shorter or more condensed my loan term is, generally my interest rate will be lower. Now, interest rates change by the minute based upon what's going on ultimately in the economic market. So interest rates could start off at one level at 7 a.m. today. They could look totally different at 1:30 in the afternoon, because they go and ebb and flow based upon kind of what's changing. So as we see, talks of tariffs that are happening, or we see, some news release that happens with job reports or inflation readings, all those things can move the markets from an interest rate perspective. Now, as you decide to pursue home ownership, we're going to help educate you on what the interest rate market looks like based upon your timeline of home buying, and meet with you for a consultation to figure out what the right product match is, and then the accompanying interest rate that would go along with that type of product. All right. Now, credit plays a big role in the selection of product, interest rate, in my overall cost of financing. So in our classes, we like to kind of explore credit a little bit with our class, just to make sure everyone understands, where credit is at. How do we optimize credit to make sure we have the lowest possible borrowing cost? Now, every loan program has a minimum credit score, and you can see some of those products on screen, like the FHA loan, the conventional loan, VA, and then for some of our rural areas that we want to purchase in, there's the USDA product. And we'll explore those a little bit more in just a bit. There's factors that can really influence a credit score, things like major events on your credit report, like a bankruptcy, a short sale, even a foreclosure, or late payments. Those all can negatively influence a score. Now, events that have happened on your scoring within the most recent 12 to 24 months are going to have the most recent activity and impact to the credit score. But as I get further away from those events, beyond 2 years, 3, 4, 5 years down the road, I should see improvement in my credit score over time. Or we're going to talk a little bit about credit utilization in just a little bit, but that ultimately what that terminology is around looking at my credit balances versus my credit limits. That usually is one of my bigger opportunities for most clients that I work with. How do we drive down credit card debt ultimately to help improve the credit score? And then we'll talk a little bit about account closure where we want to limit the activity on credit cards, but we don't necessarily close relationships on credit cards because those could have a potential negative impact on my score. And when we look at scoring for clients, we look at all three agencies. Those agencies are Equifax, TransUnion, and Experian, but we take the middle credit score for all borrowers. So for example, if my highest score is 740, let's say my middle score is 720, and then my lowest score is 700. Well, when it comes to qualifying for my financing, we're looking at the 720 credit score. But if I'm going to apply with my partner, but let's say my partner's at 680, 660, and 640, well, the lowest score between myself and my partner is actually the 660 credit score. So that's what we would use from a qualifying perspective. Now, negative items that are on your credit report, like I said, will be kind of more impactful in the most recent 12 to 24 months from the event. But this is how long they'll stay with you on your credit report. Now, more severe the event on your credit report, the longer it's potentially going to stay with you on your credit report. So if I had a late payment on my student loan back in October of 23, it's going to start seasoning off a little bit because that's a year and a half ago, but it will still have that impression on my credit report for 7 years from the date of the event. Now, there's 3 different models to credit scoring. There's credit card, there's auto, and then there's mortgage financing model. So if you're in the habit of monitoring your credit, which I would encourage you to do, more than likely, you're probably looking at the credit card model. So when I meet with clients for their consultations, oftentimes there's a little bit of a surprise that maybe their monitoring service is showing a 763 credit score, but the mortgage score shows it's 760. Not a huge deal, but ultimately, the reason why we have that variance is because we're looking at 2 different types of scores. We're looking at a credit card score versus a mortgage score. So here's what goes into the mortgage score. So 15% is the length of credit. So the longer my credit file is open, the better my score can potentially be. So, if I have long-standing relationships, 10 years, 15 years, that would probably be better on my credit reporting versus saying I have like maybe 5 years of established credit history, or maybe even 2 years. Usually it takes a minimum of 6 months of established credit history to at least be accessible for an actual credit score. Next thing is in-use credit. So that's basically how much credit am I trying to open. So we don't want to have too much credit. We don't have too little credit. But I would recommend most clients have at least 2 to 3 credit cards accessible to them. Now we want to be careful that we don't open up too much credit because, especially in the most recent 6 to 12 months, we don't want to add new credit because that could help take away from my credit score. We also want to avoid inquiries. Inquiries are when we have a lender that's accessing our credit doing a hard inquiry. Hard inquiries can impact your credit score. Now, in our process to work with you for your home buying plan, we only start with a soft inquiry. And the reason why we do that is because we know that first-time buyers have a wide range of timelines to purchase. We want to help educate you and provide you support to help you on this journey, but not impact your credit score. So if you decide to work with us in building your home buying plan, we're only going to start with a soft credit score so we don't impact that overall scoring for you. And then amount owed is the next column, and that is looking specifically at revolving accounts. So we're looking at your credit limits that you have on those revolving accounts versus what the credit balances look like. So let's say I have $10,000 in credit limits and I have $5,000 in balances. I'm at 50% utilization of credit. But let's say I just booked a super cool trip to Cabo for the summer, right? And now my credit cards are at 90% utilization. Well, in that case, I probably see some pullback in my credit score. So I would encourage our client, if we're getting ready to apply for a mortgage, let's try to pay those credit cards down to at least $5,000, 50% utilization. Once I've gotten there, let's try to get to 30% utilization. Once I'm there at that level, optimal level is 10% utilization or less. All right. Now, here's a tip to manage your credit card debt down. So when you're getting ready to apply for your home financing, let's try to get that credit balance to as low as possible. At the same time, if you looked at your credit card statements, there's 2 important dates. There's a credit card statement date. There's also a due date. Now, the credit card statement date is the date when the credit issuer sends out all of your account information to the three major credit agencies. So my tip for you tonight is that if you can try to pay down the balance or pay it off ideally before the end of the credit statement date, you're going to have a much lower balance that gets reported out to the agencies, therefore lowering your utilization and improving your credit score. Okay, so kind of changing up from paying on the due date to paying before the credit statement date, or billing statement date, I should say. Last component is payment history. That's simply put, how well am I paying on my debts? Now, if I have late payments, they're rated as 30-day lates, 60-day lates, and then 90+ day delinquencies. So the most severe my late payment is, the bigger impact I'm going to have to my credit score. And again, same rule of thumb that I'm looking specifically at the last 12 to 24 months of that payment history. All right, I'm going to take a quick pause there. Any questions from our class so far? I know credit's kind of one of those robust topics that has a lot to it. If you have any scenarios you want to share, comfortable sharing in the chat or Q&A, more than happy to answer those for you. But that kind of gives you a little bit of a glimpse into how we look at credit. One of the things that we look at in credit can be student loans, and student loans play a role in qualifying when we look at expenses versus income for clients. And student loans, for the most part, if you're not in a repayment plan on federal student loan debt, it's probably currently in forbearance because of pending litigation for forgiveness of student loan debt. Hopefully, we'll see some resolution on that in September or October. But we do assess student loan debt. So here's kind of what this will look like. If you have an FHA loan that you're using for financing, usually we take 0.5% of the outstanding balances. We assess that as the monthly payment. If I have a conventional loan, we usually use 1% of the balances, and then we use that as the monthly payment. Now, prior to the litigation with the federal student loans, we could use income-based repayment amounts if clients were in active repayment. So, usually income-based repayment programs are at lesser amounts, which helps with our clients qualifying. So, during a consultation with a client, we'll help walk you through those student loan guidelines. But ultimately, the takeaway here is that whether you're in forbearance, like most are right now, or if you're in deferment because maybe you're back in school, we still have to count a minimum payment when it comes to qualifying using student loan debt. We've provided some examples here on screen. You can see someone that has $75,000 in total student loan debt. If we're doing an FHA loan, we're going to automatically assess $375 as a monthly payment to qualify. For a conventional loan, it's usually going to be $750. So that may not change qualifying for some clients, but for others that may have more student loan debt, it might be super impactful. Now, the reason why we have to assess student loans is because in loan programs, there are qualifying underwriting guidelines. And so we have to adhere to what those guidelines have. And so in our class, I want to kind of spend some time looking at just a high level look at some of the loan programs that are available to you as future first-time buyers, some of which you've probably already heard of, but I want to kind of give you a little bit more context to some of these products. And the first one is a conventional loan, which if you think about conventional loans, those are Fannie Mae and Freddie Mac loans, have a minimum down payment of 3% of the sales price. They have a minimum credit score of 620, and they set a conforming loan limit every year. So in most parts of the country, not most parts, in all parts of the country, it's 806,500. But in some parts of the country where they're considered high cost of living areas, we can go as high as $1.2 million in amount financed. But when we go beyond that conforming loan limit, it does elevate the minimum down payment from 3% to 5% for a buyer. Now, you're going to learn a little bit about conventional loans and comparing those against FHA loans, because those are usually our two top products for first-time buyers. But we're going to compare the mortgage insurance structure on both these products. But let's first talk about FHA loans and kind of what those are. FHA loans are federally insured loans. It stands for the Federal Housing Administration, has a minimum down payment of 3.5% with a minimum credit score of 580. Now, FHA is a little bit different than the conforming loan limit for conventional because every county has a maximum loan amount based for the FHA guidelines. So depending on where you're going to buy in the country, there will be a maximum loan amount. I believe we have kind of the average max loan amount for the state of Mississippi noted here, but depending on where you're at in the country, that maximum loan amount will vary. Now, FHA and USDA are both federally insured loans. Okay. And there has been some recent changes with some of the changes in administration with guidelines for these programs. And so, we'll cover this really quickly. Essentially, what has changed is for those to be eligible on that product, you do have to be a permanent resident for any government insured loans between FHA and USDA. So if you're a non-permanent resident, then the conventional loan would be the solution for a potential buyer. Okay, so there's a lot of talk around those changes with the new administration, but that's what it ultimately looks like. So on a government insured loan like FHA and USDA, unfortunately, non-permanent residents are ineligible for those programs. For jumbo loans, those are for clients that need a little bit more financing. That comes with generally a higher loan amount and higher minimum down payment required. It's usually 10 to 15% down payment amounts, usually higher credit score requirements. Most first-time buyers are not going to elect a jumbo loan as their first financing, but it certainly is an available resource for those that need maybe a little bit of a higher price amount with their financing. And then we have the VA home loan. That's for our veterans that have served and have VA home loan eligibility. It does have a 0 down payment option, minimum credit score of 620. Really, there's no maximum loan amount for the VA product. Of course, it's available all across the country. And for veterans that have that eligibility, if there's any partial disability, they may have an exemption from what we call the VA funding fee. Of course, if you're interested in the VA product, we'll talk through your options with that loan as well. And then we talked a little bit about USDA. That USDA product, while it's government insured, it essentially allows buyers to purchase in more rural areas, minimum credit score of 620, and the maximum loan amount will vary based upon location. When we look at qualifying for USDA, it has to meet a household income requirement, which can vary by the location, and the location of the property has to be in a USDA eligible area. All right. So that gives you kind of a little bit of a high level look at products that are available to you. Certainly during our consultation, when we meet with you, we're going to figure out the right product match versus based upon your qualifying and kind of your home ownership goals, but that gives you an idea of what resources are available to you. Now, within products like conventional and FHA loans, there is a thing called mortgage insurance. And so I always like to spend some time looking at mortgage insurance for our classes. There's kind of two ways of looking at mortgage insurance. One is on a conventional loan. There's what we call PMI, private mortgage insurance. So it's essentially insurance through private companies. And then FHA has MIP, or mortgage insurance premium. There's insurance through the Federal Housing Administration. And so there's different ways that those premiums are calculated. And so let's look at conventional PMI here, first of all. And so there's different factors that go into PMI for conventional loans, like down payment, your credit score, how much you decide to finance. That all gets factored into what you pay as a premium for mortgage insurance on a conventional loan. Now, conventional loans do have a cancellation option. So once I reach 2 years in the home and I have 20 to 22% equity, I can apply to have the mortgage insurance completely canceled without having to refinance my home. Now, if we look at the calculation for mortgage insurance for a conventional loan, let's say I financed $300,000, I put 3% down, and I had a 740 credit score, my PMI is probably about $92 a month, okay? Now, when you're starting your home search, maybe on Redfin or Zillow, and if you try to put in that same calculation, you'll find the calculators show a much higher premium. That's the reason for that is because they're not really calibrated to these three factors: down payment, credit score, and loan amount. So as I meet with you to design your home buying plan, we'll figure out exactly what your PMI calculation looks like. Now, PMI and MIP is essentially insurance that protects the lender against default by the buyer. On a conventional loan, when I put less than 20% down, I do have to pay mortgage insurance. And then on an FHA loan, regardless of my amount of down payment, I do have mortgage insurance. And that MIP looks like this. So I have monthly mortgage insurance. That's 0.55% of my loan amount. And then I have upfront mortgage insurance, which is 1.75% of my loan amount. Now, on an FHA loan, I cannot cancel mortgage insurance unless I refinance out. So most of my clients that are going to use FHA for their home ownership plan are going to use that as more of a temporary solution, because as maybe they improve in credit, maybe finances change, we would really want to look to try to transfer or refinance from FHA to more of a conventional product because of all the benefits we've highlighted earlier. Now, if we look at FHA from an MIP perspective, we take the same amount of $300,000 financed. My upfront mortgage insurance premium that gets added into my loan amount is $5,250, and then the monthly mortgage insurance is $137 a month. So A little bit of a higher cost structure with the FHA loan versus conventional. But at the same time, the qualifying variables and the guidelines look a little bit different in FHA versus conventional. FHA will have a lot more flexibility than maybe we'll have in conventional. There's lower credit score requirements. If I've had a late payment, let's say on that student loan back in 23, might be a little bit of a hurdle with conventional, maybe not so much with FHA. So as we get a chance to design your own home buying plan, we're going to figure out what the right product match is, but I want to give you a sense of some of the features and benefits of those products as you're considering home ownership. Now, kind of continuing on in our discussion tonight, we want to talk a little bit about qualifying income. Questions that come up from our audience about like, what are different scenarios that can work for me with home buying? I think it's important to understand that in home buying, we just have to validate at least 2 years of income history and or educational history. So I may have started a new job, for example, on January 1, even though I've only been on that job for, let's say, 3 months, I can still potentially qualify for a mortgage. And we'll talk more about that in just a bit. First, I want to kind of share with you some of the documentation that's generally needed as you start this path towards homeownership. You can see some of that stuff on screen. Usually, we need the last 2 years of income proof in terms of taxes and W-2s received from your employer. Usually, last 30 to 60 days of pay statements. And then from an asset perspective, generally, we'll request the last 60 days of bank statements. So that allows us to validate essentially some of the inputs from your application that you previously submitted to us. Now, let's get back to the 2-year history requirement. And so in financing, we have to verify a 2-year history of employment and or education. So if I graduated from Mississippi State, let's say at the end of 24, and I just started my job in 25, I could still be eligible for financing because I can demonstrate a total of 2-year history of education and employment history. Now, if I'm getting ready to transfer a job, I've been on my job for say 6 years, but I'm going to start a new job on May 1st, I can still potentially qualify for home financing with that job that I'm starting on May 1st. Now, with the 2-year rule in financing, if I have dual employment, so let's say I'm working for 2 different employers in the medical industry, right? I work 30 hours at one clinic. I work 20 hours at another clinic. If I want to include both sources of income, then in that case, I have to demonstrate that I can handle 2 jobs simultaneously for a 2-year span of time. All right. Now, 2 years also comes into play for self-employed clients. I have to show as a self-employed individual. So if I'm a 1099 independent contractor, I open my own business, whatever the case may be, I have to show 2 years consecutively of tax filings. All right. Now, if I have other sources of income, let's say I work 40 hours a week on my job, but I like to drive for Uber and Lyft on the weekends and earn some extra money. If I want to introduce my side income from Uber and Lyft to the equation, that will be part of what we call Schedule C income on my federal tax returns. We can use that income, but we have to show, again, the 2-year rule of being on my job for at least 2 years and demonstrating that I can also do my work with Uber and Lyft simultaneously. All right. Now, if I have other sources of income, like let's say my partner contributes to our household expenses, but my partner doesn't really want to be on the application, that's totally okay. We just can't introduce that income for qualifying. If we do want to have that income help us out with our home purchase plan, then that person would have to also apply on the loan. And if you're currently collecting, let's say, room and board for a roommate that you have in your place, generally that income is not going to transfer to the budget for home buying. Okay. So that's kind of what it looks like from an income perspective, because ultimately we're going to take that income that we validate for you. We're going to compare that versus the expenses that you have, including expenses like personal loans, car loans, credit cards, as well as the new housing budget that we're going to help create for you. So we look at a thing called debt to income ratio, which is essentially those expenses versus the income. So if we think about home ownership budget, we're looking at the principal and the interest that I'm going to pay for my mortgage, the expected property taxes for the house, the homeowner's insurance that I'll have to pay to help insure my house, mortgage insurance that we just reviewed a couple minutes ago if I put less than 20% down or I do an FHA loan. Or let's say I'm going to live in a community that has a homeowners association dues. That would also get factored into that budget. So ultimately, as a lender, and I have a scenario on screen here for you. If we have a housing budget that's at $2,500 a month and my other expenses are $500 a month, that means my projected home buying plan has me paying about $3,000 in outgoing debts. If I compare that to my pre-tax income, let's say is $8,500 a month, that means 35% of my income, or what we call debt to income ratio, is being consumed by those expenses. Okay, so those are one of the metrics we look at from a qualifying perspective for home financing. Now, the question I get asked often is, well, what should my debt to income ratio be? Well, from a qualifying perspective, we ideally don't want that debt to income ratio to be more than 45 to 50% on the high end, right? Now, the sweet spot or comfort zone for most buyers is going to be around 33 to 36%. I would consider that excellent, if you will. But I think the cost of living by state will change that a little bit. So if you're in a lesser affordable market, you probably have a higher debt to income ratio potentially because it's higher buying costs. Maybe lower cost of living market might be slightly lower, but everybody's situation is a little bit different. Ultimately, our most important takeaway in our conversation around debt to income ratio is more so looking at affordability. And affordability is about what can I think I can afford that's realistic, that maybe I don't have to make any lifestyle changes, that's not going to be pressing for me or stressful as my monthly payment. We want to make sure we're affordable and then sustainable too. So if things change for me economically, I can still kind of take on my mortgage payment without any kind of challenges at all. All right, last thing I want to talk about before we go into the buying process is to talk a little bit about down payment. When I think about home ownership for our buyers across the country, there's usually two challenges to home ownership. One is maybe I need to kind of restructure my debt. Maybe I have a little bit more overextended with credit cards or some past legacy issues with my credit cards, or it can be around savings. And so as we talked about earlier, as we launched into class, we have to save up for down payment as well as potentially closing costs for home ownership. And that can be a real challenge for a lot of our buyers. That may push out home ownership 2 or 3 years from now, but there are assistance programs available that can make it more of a near-term goal. We'll talk about that just in a few minutes. I want to first kind of share with you what we generally will look at to validate assets if we've already been kind of saving for home ownership. So we usually look at checking and savings accounts to validate that information. Retirement accounts can be potentially used. In brokerage accounts, even gifts from family members are allowed. In fact, a family member can gift your entire down payment and closing costs. So there's really no minimum investment required on, say, a conventional or FHA loans. Now, as we're preparing for home ownership, savings is, like I said, going to be a challenge for you, potentially. And so we want to talk to you about a savings plan that we like to share in our classes to make things a little bit more attainable for us and to kind of plan in home ownership. And so here's how this kind of savings plan approach looks. So if I'm currently paying, let's say, $1,500 a month in rent, after meeting with us for a consultation, we've created a plan that has us paying about $3,000 in mortgage expenses. Right now, I have about a $1,500 gap from where I'm paying right now versus what I think I can pay in mortgage. And let's say I'm just lacking savings. What I would encourage our client to do as part of that session is to now start saving like I'm actually paying the mortgage payment today. So on the first of the month, when I pay my landlord the $1,500 a month in rent, I create the discipline of also transferring $1,500 additionally to my savings account on a monthly basis. And it does a few things as I create that structure or discipline for myself. One is obviously I'm building savings. So at the end of maybe 6 months, I have $9,000 available to myself. At the end of the year, I have $18,000, not including interest. So we create that savings discipline and that rhythm, if you will, of also making a $3,000 mortgage payment. So when I do get the keys to my home and I have to make the first mortgage payment, maybe it's not as big of a payment shock for myself. And $18,000 or even $9,000 can certainly be enough of a nest egg to help a client achieve home ownership. So that's kind of what our savings plan looks like. Now, if you're looking at buying with additional resources, first-time homebuyer programs can also help. Most first-time buyer programs will help support low to moderate income households across the country. Now, most states have what we call as a housing finance agency that does exactly that. And so depending on where you're going to purchase, we kind of spotlighted one of the Mississippi housing programs here, but you could be in Virginia or Texas or Louisiana. There's programs all across the country that can help support you with resources around home ownership. And so here's one of the programs available in the state of Mississippi, allows you to get $6,000 to $10,000 in down payment assistance of a 0% interest loan. Generally, that loan is not paid back until you either sell or if you refinance in the future. There's also special incentives for teachers and a mortgage credit certificate program. And mortgage credit certificates are an awesome vehicle for you to create tax savings. Ultimately, what a credit certificate does is allows you to get a tax credit of a certain percentage of the interest that you pay on a mortgage. And so that's something that would be of consideration for you as a first-time buyer. And there's also local and kind of targeted programs that are feature, more benefits for low-income housing buyers. So that's specific to Mississippi. And we do have a kind of a private label program within APM called our Pathway program. It's only available on the FHA product, but it does allow buyers to get 3.5% to 5% of their loan amount in assistance funds to help kind of close the gap from what we have in savings versus where we need to reach to for our down payment and closing costs goals. All right. So if you have any questions about some of the first-time buyer programs that are available to you in your local community, please get connected with us. You'll have the opportunity to schedule an introductory call with us, and we can certainly talk about what community programs are available in your local market. All right, before we talk a little about the buying process, I just want to open up. I haven't had any questions yet. I guess that means I'm very thorough or whatnot, but do you have any questions from the audience that I can help answer in class so far? We're almost to the top of the hour, but I do want to walk you through the buying process because I think that's an important kind of next step from today's class. So let's talk a little bit about the buying process. And so this is our 6 steps of home buying that you can see on the screen. So it's kind of where do I go here after class? Where do I start on my path towards home ownership? Well, step 1 is what we call as pre-approval. And that ultimately is basically the framework of your financing. It allows you as a potential buyer to have a certificate that you can present to a selling agent of a home or a seller and say, I am qualified for my home financing. Usually that pre-approval is good for 60 days, but it can be always recertified for you at any time. That pre-approval comes from the basically consultation that we do with you as a one-on-one 30-minute video session to help design your home buying options. We'll talk more about that as our 3 steps of get started process. But the pre-approval would kind of start us on home ownership. And so that would be step 1. We did have a question come in the chat, which is how long does the entire process take? So we're right on time for that. The process from going from pre-approval or from application submission to pre-approval can be as fast as 24 hours, depending on how fast you want to move. To go from pre-approval to actually getting the keys to your house, that depends really about step 2, which is the buying process, or the house hunting, I should say. House hunting can be one of the longest phases of the process, depending on what community I want to be in. If I have a specific neighborhood or school district I want to be in, that might take a little bit longer versus maybe I'm a little bit more flexible. I would say for most buyers, house hunting takes about 3 to 6 months. And then once I go under contract with the seller, it's generally about 30 days from accepted offer to the time I get my keys to my house. Okay. Okay, I appreciate that question. Step 2 is house hunting. So that's where I'm actually going out and looking at homes. It probably starts online and then eventually it'll go to in person. We would encourage you to get connected with a realtor in your local community. That it should be an expert on, what's going on with the school district, what, lifestyle needs you have in a community, the specific property you're looking for, all those important characteristics that you're going to need in making a good informed decision. A local realtor should be able to provide that. Now, again, from my perspective in working with first-time buyers across the country, it takes about 3 to 6 months to find the right home. But when you do, then you'll be submitting an offer to a seller. And it might not happen the first time. It may take 2 or 3, 4 or 5 times, depending on how competitive your market is. But let's say once I get that accepted offer, then I'm going to move to step 3, and that's called entering escrow in most parts of the country. Ultimately, you and the seller have come to terms with a purchase price and an agreement of the terms of your contract. And to go from step 3 to step 6, again, it's about 30 days. It can be different time frames depending on where you're going to buy in the country. And at that point, you're going to get a call from our team congratulating you on your accepted offer. I'm going to call you and say, hey, guess what? We got the word that you got your offer accepted. We're super excited for you. Let's get you scheduled for your follow-up video session, and let's talk a little bit about next action items for you. Now, that usually happens within 24 to 72 hours from the date of the acceptance. As a buyer, you also need to deliver your your initial deposit, which is called an earnest money deposit. Usually in about the first 1 to 3 days of the contract period. That amount of funds is usually 1 to 2% of your purchase price. Now, that does count towards your total out-of-pocket expense. Now, within a couple of days, like I said, we're going to be connecting with you for a follow-up video session. And in that video session, we get a chance to talk a little bit about your loan structure, make sure you're feeling comfortable with the monthly payment, the out-of-pocket expense, the application of appropriate first-time buyer programs potentially. And we'll talk strategically about where the interest rate market works or what it looks like and how it works for you. Here's a slide that kind of shows you about the earnest money deposit. Again, that's 1 to 2% of your purchase price. That money is generally protected in most parts of the country by what we call as contingency periods that are in the real estate contract. That essentially allows you as a buyer to do your investigative work on the property. That would include getting your house appraised to ensure the value supports the purchase price of the home, getting your inspections done, whatever inspections are recommended by your realtor. It could be a sewer inspection, roof inspection, pool inspection, whatever it might be. And then also getting your loan approved. In most parts of the country, that'll happen within the first 14 to 21 days of your contract. So you'll have that time frame to do all of your investigative work on the property to make sure it's still a good fit for you. Now, behind the scenes in the lending world, we're working on the processing and the underwriting of your loan. That includes the administrative work of your loan, like verifying your income, your assets, kind of putting all the finishing touches on the financing, so we can ultimately submit everything to an underwriting team that's going to review and validate all the information in your application to ensure it kind of checks the boxes with the guidelines for the program that you're applying for. Underwriting doesn't take too long, but I would say the first 10 to 12 days will lead us into underwriting of your contract period. So we kind of move through the path to home ownership. Step 5 is the loan approval. So we issue an actual loan approval from an underwriter. There will be probably some tasks that you will be doing as part of that approval. Our team will partner with you on any of those conditions that we have of the approval. And as we work through those conditional items, we're going to start putting the final touches on everything, because now we're about 3/4 of the way through the process. We're going to issue to you a final closing disclosure that gives you a 3-day cooling off period before we get to the very final stage. And by the way, all of the disclosures you receive in the lending process are all electronic disclosures. So everything is done electronically, including your first initial disclosures, what we call as a redisclosure once your interest rate is locked, and then finally a closing disclosure that gets generated within 3 to 4 days prior to the closing of your loan. At step 5, that will also bring you to the end of your contingency period. So if everything checks out in your investigative work on the house, you still feel really good about the home purchase, then you're going to work with your realtor to sign off on your contingencies, which ultimately tells the seller that, hey, everything's good on our side. Think it's a great fit. We want to move to the final stages of the process. And that final stage is the closing of the loan. And that happens after your cooling off period from your final closing disclosure. That is the in-person process of the buying process. It usually entails you sitting down with an escrow officer or title agent or an attorney, depending on what state you're in. Usually that takes about an hour or so in time to sign all the final loan documents. You're going over everything, including assistance programs that you might elect. After that signing process is done, then you'll generally wire in or provide a cashier's check for the final amount of funds owed. Those monies will then get reconciled with your loan funds by the escrow or title agent. They ensure that you're contributing what you're supposed to as a buyer, and the seller's receiving the proceeds that they've expected. After those monies are all reconciled, then documents get recorded with the local county recorder's office. They record what we call as a grant deed to transfer ownership to you, as well as the deed for the financing security instrument for the loan that you're taking out. Once all that stuff gets finally recorded, they get confirmations back that ultimately indicate the transfer of ownership and the recording of the deed, and then you become the official owner of the home. And that's a call we get a chance to say, hey, congratulations, you did it. You made it on the path towards home ownership. I know we've had a fellow Mississippi State alum purchase using APM and get you to the final stages of the process. And that is such a joyous day for us. We get a chance to make those calls every day. It is a celebration. It is going to be one of the biggest achievements you have financially. So we're excited to be a partner with you on that journey. So it's a big day on closing day. Now, our relationship with our clients doesn't stop once you get keys to to the house. Part of our aftercare we have with our clients is to monitor you on what's happening in the market rates. So if a refinance opportunity presents itself, we'll be able to do so and notify you with our rate watch system. We have a HomeBot system that tracks the progress of your home equity. And we always try to connect with our clients at least annually to update you on new products or refinancing opportunities that exist with you. You know, we look at this as a long-standing relationship, not a transactional situation. So we always want to be with you as things change for you over the course of life economically. Now, as we're wrapping up, we have a few minutes before we hit the top of the hour. I just want to share with you how to move forward in the process. So if you think you want to build your own home buying plan and partner with us, we'd love to be able to do so. It's a real simple process to get started. We call it our Get Started information. You'll complete an online application. We only do a soft credit check. You'll upload requested documents to the application portal, and then you'll use our scheduling system to schedule a video call time that works good for you. And that's a 30-minute session where you're working one-on-one with me to help design your options along with our team to make sure you have a home buying plan that's going to equip you to help you on this journey. Now, whether you want to buy in 2025 or maybe it's a long-term goal of 2028, that's okay. We'd still want to get partnered with you for a consultation. Now, if you have some questions about some of our content today, or maybe just have a scenario question you want to run by us, we'd encourage you to use our same scheduling system and book an introductory call with us. We'd love to take some calls after our class to maybe answer any specific questions you have for our team. Here's what a consultation looks like. It is a very comprehensive plan. It is different than what most lenders do because we pride ourselves in being the leader in homebuyer education. So I really think it not only starts with our workshops, but where we go from there in terms of meeting with you to design a comprehensive plan. That includes looking at your housing budget, building a plan for maybe credit potentially or savings, understanding where do I want to buy and what products might match up for me. Really just understanding how we can best support you on this journey towards home ownership. And again, the output of that session is to be pre-approved for your home purchase. And I just want to reiterate, that is a free service we provide. So whether you're buying now or later, it's a free service available to you as we support our communities in homeownership. One other thing I want to point out is our mobile resource. So if you want to get started in the process via mobile, you can do so. You can do application right from that mobile tool, whether on Android or Apple. You can also follow the progress of your loan, also use our calculators, which is really simple and easy to be able to run payment scenarios, maybe on a property that you have some interest in. So we'd encourage you to check out the mobile. We have all our links there that'll be included in tomorrow's presentation material that you get via email. I just want to again remind you that you do have a $750 closing cost discount as partnered with our Mississippi State Alumni Association. So we really want to spotlight that for you. And we do have other partnerships across the country too. So we teach over 60 classes a year in homeownership, usually one per quarter for every partnership we work with. So if you have friends, family, coworkers that think might really benefit from these value-added resources, they can always come check out one of our free classes. You can see a full list of our classes by visiting us at mortgageeducate.com. And before I open it up for more questions, here's all my contact information. So if you do have a follow-up call or a question after tonight's class, feel free to send me a message. You can obviously visit our site as well to schedule a call time if that's a little bit easier for you. We appreciate you taking time out of your busy Wednesday schedules. I know there's other things you could be doing on a Wednesday night. We appreciate that you took the time out to join it with us, and hopefully you have one or two, maybe three things that you can take away from tonight's class that will help you achieve this financial homeownership goal. All right. Well, that takes us to the end of class. Before I sign off, do we have any questions from the audience that maybe didn't get asked or answered? Any questions I can help from the group? Okay. Right. Oh, I think we got everything. All right. Well, it was a pleasure bringing this content to you tonight. I do hope I get a chance to connect with each of you and provide you your own customized path towards homeownership. Have a wonderful night. I'll be looking forward to talking to you soon. Good night.